Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending March 27, 2026. So as the title of the review says, it's 4 weeks in, or so it's the 1 month anniversary of the current conflict. The first strikes happened on the night between February 27 and 28. A month ago. There's been lots of damage on the markets. Central bank pricing has changed quite a bit, but we'll also look at how the expectations towards the 2026 midterm elections have shifted since, because that's a very important part of the puzzle as well. But before we go there, looking at this week's markets at the close on a Thursday, positive for bonds. Just before I go into the details, remember that pretty much every Friday since the conflict started has been negative, because investors tend to want to de-risk ahead of the weekend, because you never know if there's going to be an escalation or any surprise there. So, things might change, and this morning markets are in the red. So let's see how we end the week, but still positive for bonds after 4 days. The TSX up 1.8% on the week, so pretty decent week. You do start to see the cyclical trade making a comeback on up days. The cyclical trade that we've seen since the beginning of the year continues to get some fuel, and also very interestingly, on down days, you don't see that much volume recently. And just as an example, yesterday, Thursday, was the worst day for the market since January in the US, but it was the second lowest volume on the year. So you're seeing less and less conviction on the downside. You do see lower and lower highs, so this is not bullish for sure. But when you look at the checklist of oversold conditions for the market, you're starting to check a few boxes. So no, it's not a reason to be thinking that the markets are just about to bounce. That's not what I'm saying at all. But you're seeing the surveys from Goldman Sachs and from Deutsche Bank showing that positioning is getting light. So there's more and more investors who have sold and they are in cash and they're waiting to get back in. Sentiment also has turned cautious. So those are all conditions that usually point to a balance of risk, where when we do get some real closure on this situation, maybe the markets could claw back some of those gains rapidly. But we do need to have some closure on the Strait of Hormuz, and on that we have absolutely no views or edge compared to anyone else on how quickly or when this will happen. But just describing the internals of the market here. The TSX done well on the week, year to date still positive. Canadian dollar was down 1% this week. It's mostly the USD which is acting like the safe haven right now. That's helping the value of your investments outside of Canada. As you can see here, the S&P 500 went from minus 0.5 to plus 0.5 on the week. EFI is up close to 2% in Canadian dollars. Emerging markets flat. Year to date, still the same order. Emerging market first, TSX second, EFI third, and then you have the US largely behind. Price of oil up 65% year to date, and of course gasoline prices are up as well. Canadian dollar, euro down. Price of gold, very important here to spend let's say a few seconds on that. 1.3% year to date, so that's quite a drop from the 5,600 level that we touched at some point this year. 2.6% lower on the week. So I've mentioned that often. Theoretically, there is no fair value on the price of gold. You cannot devise a fair value model. You need to look at what the market is telling you, and the market at some point will tell us that we've hit the bottom, and it's going to be likely consolidate for a while there. Could last a few months, can last for a few years, consolidation of the price of gold, and then at some point we'll have some resolution after this consolidation. So usually that's how it operates. But while it's dropping like this or it's volatile, trying to catch this and trying to time that market to the upside, that's quite difficult. So anyone out there who's been trading gold with lots of success over the last few years would advise some caution here on trading the price of the yellow metal. because the market is telling us that this is there was a lot of hot air in that balloon, and this is still deflating. Now, looking at the topic, so the first two slides will be on the midterm. So the first one here, you have two charts. On the left, you have who will win the House in 2026 in the midterms, and on the right, who will win the Senate. It's been more than a year that it's been pretty much a given through looking at the surveys and the setup of the elections, whatever you look at, that the Democrats will be taking the House. And it's even more likely now, 85% odds, according to Polymarket. So these are prediction market data. So the Democrats are set to take the House, and this is just even more likely than it was recently, but it's always been the base case. Now for the Senate on the right, the common thinking was that the Republicans were going to keep the Senate. It was too steep a slope for the Democrats to come back and take it. But now look at how things have changed. Already in February, we went from 65% that the Republicans will keep it to 60%. But since the conflict started, now it's neck and neck. And of course, there's one thing that the American population does not like, is that when there's a conflict somewhere else in the world, which is pushing inflation higher domestically. And of course, there's very little support behind this Iran operation, whatever the president might say. So Democrats are it's a coin toss for who will be taking the Senate here. So that brings us to the next slide on the balance of power. So what kind of combination are we looking at here? Well, the likeliest scenario, which is still 48.5%, has 48.5% odds. So it's not majority scenario, but it's still the likeliest one, is that we have a Democrat sweep. So the Democrats taking both the House and the Senate. And if you go there, of course, that means that the president becomes lame duck. And of course, the motions to impeach will not be far behind. And Donald Trump will be facing a position. He won't be able to do whatever he wants like he's doing right now. So that has lots of consequences, and that could be market friendly because markets tend to like gridlocks in Washington. So this is the likeliest scenario, but still less than 50% odds. The second one is that we have Democrats taking the House, Republicans keeping the Senate, so that's 36.5% odds, and then after that you drop down. So very important, and the shifts in those odds since the beginning of March are very telling. Of course, there's lots of time before the election, but that does play a key role in incentivizing the president and the White House to get out of this conflict as quickly as possible. So we'll see what happens. There's many considerations, but of course, if they want to ensure the future of the political future of the Republican Party, at least for the next 2 years, well, this is starting to be a bit more urgent than what we might think. So that's it for the midterms. We'll continue to follow that for you over the next months for sure. Now looking at the markets, so the focus should still remain on earnings. Chart on the left tells us that the pullback that we've seen in stocks so far is pretty much exclusively about valuations. That is outside of Europe, but in the US, Canada, emerging markets, it's mostly valuations. So that also means that if we do have a resolution to the conflict and the Strait of Hormuz reopens and there's confidence in the market, then you could have a swift turnaround. We don't know when, we don't know if that will happen, but this is what this tells us, because on the right, focus on earnings, as we said, Europe, the expectations for growth in earnings over the next 12 months was revised quite lower, from 23% to about 13%. Now we're back up to 15%, so maybe there's something good there. But in Canada, in the US, in emerging markets, pretty much as steady as she goes, around 20%. So markets are still expecting good things for markets moving forward, for the ability of businesses to grow their earnings. It's mostly sentiment, it's mostly valuations now. So while that lasts, that gives us some reasons to be optimistic that you could have a solid rebound whenever this thing is resolved, unless of course it lingers for too long, and then you start to see inflationary pressures that are, let's say, more broad-based, and then that starts hurting earnings expectations, and then that's a different market. But let's say for the short run, if there is a resolution, that's a positive development here. markets are also trying to decipher what the central bank playbook. So what should central banks do? The theoretical framework, which you can find in academic literature, is that central banks should not cut rates even if the economy goes into a recession. I mean, usually you want to make sure that you don't de-anchor inflation expectations. So it's hikes rather than cuts. So it's normal that markets are depricing cuts in the US and pricing hikes in Canada. But also the playbook is that at first you look through the first round effects and you use forward guidance. So you use words and you use speeches. So the Tiff Macklem, the Bank of Canada governor, did that last week. He did it very well, just guiding the market that the bank is ready to act, that it's in the risk management framework and all of that. So he's guiding the market, keeping the credibility of the central bank. And for the Fed, yesterday there was a speech by Vice Chair Philip Jefferson. They're pretty much the same thing, saying that they think that the best thing for the Fed to do would be to stand pat, and inflation expectations now, they're monitoring that, and there could be inflationary pressure. So they're doing that. So the forward guidance. After that, to proceed with hikes, it would take sustained inflation. It would take inflation expectations that become de-anchored. We don't see that yet. And for the Bank of Canada, as we can see on the left, to hike, let's say 3 times by the end of the year, we think this is way overblown by the markets. Maybe we can have a hike by the end of the year, but likely that would take inflation that, rather an oil shock that lasts beyond the summer, and then have inflation expectations that become de-anchored, and then you have core inflation that starts to rise because the price of everything rises, because the price of gasoline is higher. So the core inflation gaining some traction, and then you could see 1 rate hike by the end of the year. We think more than that would be exaggerated, so we think the market is off base here, pricing at 3 hikes. For the Fed, staying pat or maybe hiking once makes sense, so we're not that uncomfortable with the pricing from the Fed on the right. And in fact, we did run our internal models. Here on top, you have the US. On the bottom, you have Canada. So we have 3 scenarios. The blue line is pretty much becoming an alternative scenario because limited and temporary shock. This is pretty much a scenario where the conflict would need to end right now or in the next week or 2. So it's getting unlikely, but still. Then the Fed maybe could proceed with 1 cut towards the end of the year. Rates, 10-year rates could go up a little bit because there's still inflationary pressures in the system. If you don't have that, if you have a severe shock or a very severe and prolonged shock, then the central bank would either stay pat or start hiking. So this is what we would have from those scenarios. So the base case is that the Fed stays on the sideline. Odds are that it would take again a very severe shock and a prolonged shock for them to hike. For the Bank of Canada, the base case is that they stay pat. If we have a severe shock, maybe 1 hike by the end of the year, but to have 2 hikes, it would take a very severe and prolonged shock. So it's not our base case either here. So lots of moving parts here. Just want to tackle a bit of everything. So it's mostly valuations that have contracted in equities, central banks. Of course, forward guidance. The markets are starting to expect, trying to let's say to decipher the playbook. The playbook is tilted towards more hawkishness rather than dovishness, but so far I think some of that might be overblown. And don't underestimate the impact of internal politics and the midterms in 2026 as a deterrent for the US to get stuck into a long-winded war. But again, who knows? So what we'll be watching next week in Canada, January GDP and S&P Global PMIs. In the US, consumer confidence from the conference board, not crashing, but it is declining. So let's see what's going to happen next week. Retail sales should be higher because of higher gasoline prices, so households are spending more. ISM manufacturing index, it has been trending higher, mostly because of the inventory cycle, which is brewing in the US. So that should be supporting manufacturing activity. And non-farm payrolls, of course, the ever important indicator to gauge the state of the labor market in the US. So that wraps it up for the week. Many moving parts here, so we'll always be here to help you stay on top of things. So if you appreciate the content, please share, and of course, come back next week.